What if I told you there's a proven blueprint behind the world's most successful companies? A formula that takes ordinary businesses and turns them into unstoppable money-making machines, delivering returns for decades, generation after generation. It's not a secret. You see it in companies like Amazon, Apple, or Visa. But not many know exactly what makes these businesses compounders. Today, we're diving into the 6 key principles behind every great compounder, the principles that savvy investors swear by. If you can understand these, you can identify the companies that will change your financial future. Welcome to Sage Investing, bringing you timeless investing wisdom. If you're looking to improve your investing knowledge, make sure to subscribe and hit the like button if you found this useful. The first principle: franchise durability. But what does that really mean? Picture this. You're walking into a store, and there are dozens of soft drinks lined up. You grab a Coca-Cola without even thinking. That's the power of strong franchise durability. It's brand recognition at its finest. But it's not just about being well-known. It's about being irreplaceable. These brands can charge a premium because customers trust them. That's pricing power. Coca-Cola didn't just become a soft drink. It became the soft drink. This type of staying power in a competitive market is the cornerstone of a compounder. When you spot a company that can keep competitors at bay and continue to raise prices without losing customers, you've found a potential gold mine. Moving to the next principle, high return on capital employed. Now, ROCE might sound like a boring financial metric, but trust me, it's one of the most important numbers to watch. In simple terms, ROCE tells you how efficiently a company uses its money to generate profits. The best compounders consistently earn returns far above the cost of capital, with exceptional companies boasting an ROC above 15%. They don't just throw money at problems. They invest it in ways that generate more money. Think of it this way. If you're investing in a company, you want to know that for every dollar they spend, they're making back multiple dollars in return. That's what separates a compounder from the rest. You're not just looking for businesses that are profitable, but ones that have mastered the art of reinvesting their earnings at a high rate of return. Now, the third principle is a big one: recurring revenue. This is where the magic of compounding really starts to show itself. The best businesses aren't just hunting for that one big sale. They're focused on creating a steady, predictable stream of income. Look at companies like Microsoft, which turned its once one-time software sales into recurring subscription services through Office 365. Instead of selling once, they're billing customers every single month. The beauty of recurring revenue is predictability. It smooths out the bumps of market volatility and creates a reliable income stream. When a company doesn't have to start from zero each month, its growth can snowball. And when it's done right, it creates a fortress-like business model. Debt can be a powerful tool, but for a compounder, minimal financial leverage is key. These businesses don't need to take on mountains of debt to fuel their growth. In fact, they thrive without it. Think about it like this. If a company can grow without being heavily reliant on borrowed money, it's much less vulnerable when times get tough. Compounders avoid the risks associated with high debt loads, focusing instead on steady organic growth. A good rule of thumb here is to look at a company's debt-to-EBITDA ratio. For compounders, this number is often below 3x, meaning the company's long-term debt is less than 3 times its earnings before interest, taxes, depreciation, and amortization. Visa exemplifies this principle. It generates significant cash flow through its transaction processing model, maintaining a debt-to-EBITDA ratio well below 3x. This healthy balance allows Visa to remain resilient during economic downturns while continuing to invest in growth opportunities. If they can keep that balance healthy, they're in it for the long haul. Next up is a characteristic that really sets compounders apart during economic downturns: low cyclicality. Some businesses thrive in boom times, but struggle when the economy hits a rough patch. Compounders are different. They're resilient and able to make money no matter where we are in the economic cycle. That's why you see grocery stores, healthcare companies, and utilities as some of the best compounders. They're needed in every part of the cycle. A prime example of a low cyclical compounder is Costco. This membership-based warehouse club offers essential goods at competitive prices, which makes it particularly resilient during economic downturns. Even when consumers tighten their budgets, they flock to Costco for value, helping the company maintain steady sales and strong membership renewals. When evaluating a company, ask yourself, can this business weather a storm? If the answer is yes, you're looking at a potential compounder. Last, but certainly not least, a true compounder returns capital to its shareholders. This could be through dividends, stock buybacks, or ideally both. The key here is not just the ability to generate cash, but the discipline to return it. Companies that do this show they value their shareholders. A prime example is Apple, which consistently returns capital through regular dividend payments and aggressive stock buyback programs. By generating substantial cash flow, Apple rewards its shareholders while continuing to grow its business. And here's the kicker. As these companies compound their earnings, they're also compounding the returns they give back to you. Dividends increase, buybacks make your shares more valuable, and the cycle continues. So, there you have it, the 6 principles that define compounders. These are the traits you should look for in any company you're thinking about investing in. Strong franchise durability, high return on capital employed, recurring revenue, minimal financial leverage, low cyclicality, and the ability to return capital. Not every business can be a compounder, but when you find one, it can be life-changing. So take these principles, do your research, and keep your eye on the long game. Because compounders aren't just companies, they're the engines that drive your wealth forward.